Hi, this is Rhonda with Accessible Lending, sponsored by DeVito Lending and with Lending for Investors. I am a Florida mortgage loan originator as well as a hard money broker. Today we are going to be discussing conventional loans or lending versus non-traditional or non-conventional loans or lending, the difference between those two, and how to determine which loan product is right for you. So loans that are not insured or guaranteed by the government, these are considered to be the conventional loans. These loans are backed by private lenders and they typically conform to guidelines by Fannie Mae and Freddie Mac. Now, Fannie Mae and Freddie Mac are two government sponsored enterprises, which are called GSEs. GSEs are not directly owned by the government. They operate under the congressional charter and are regulated by the Federal Housing Finance Agency, or the FHFA. The purpose of GSEs are to buy mortgages from the lenders like the banks, credit unions, etc. They pool and securitize those mortgages into mortgage-backed securities, or MBSs. Those securities are then sold to investors, which help to free up that capital so that they can basically do it all over again. So the key takeaway is that conventional loans are not insured or guaranteed by the government. So some of the benefits of the conventional loans, as you can see here, they're lower overall cost. There's a no upfront mortgage insurance premium, or MIP, once you reach that 20% equity threshold. So if you say put 20% down as a down payment, you would not have mortgage insurance premium. If you put 10% down as a down payment, and within say the first year or two you reach that 20%, then after that first year or two, no mortgage insurance premium. So that's one of the benefits. More loan options, because it can be used as your primary, secondary home, or if you're wanting to get into investing, you can pick up investment properties. Faster processing time, less bureaucracy compared to the government loans, which can lead to the quicker approvals and closings, and competitive interest rates. Strong credit borrowers, or people that have higher credit scores, basically, can often get greater rates than with the FHA, Federal Housing Administration loans, or with the USDA loans. More flexibility in terms. It can vary from 10, 15, 20, 30-year loans, including the adjustable rate mortgage loans. No upfront funding fees. So unlike VA or the USDA loans, conventional loans don't charge upfront guarantee or funding fees. Types of loans: conforming loans, non-conforming loans, the fixed rate conventional loans, ARMs or the adjustable rate mortgages, the low down payment conventional loans, and the investor loans, which are the portfolio loans. To choose what loan is best for you, you're going to want to consider the following five things. The first thing is that the purpose of the home. Is this going to be your primary home, your second home, or an investment property? Second, you don't have to know exactly, but you do want to have like a ballpark figure of what your credit score is. Third, how much will you be paying for your down payment? And then four, do you want a fixed or an adjustable rate mortgage? Lastly, you want to have the estimated loan amount or the price of the home. So, for example, say it's going to be your primary residence, credit score 680, requesting a fixed rate, paying 5% down, and the loan amount is $450,000. Now, for that scenario, the best loan product is the conforming fixed rate conventional loan. Now, either that's going to be Home Ready by Fannie Mae or Home Possible by Freddie Mac, but it's the best loan product to fit this situation. And it's a good fit because both programs, the Home Ready and Home Possible, are designed for owner occupancy. The credit score is well within the required limits. Program accepts as low as 3% down. Their down payment is 5%. They can lock in a 15, 20, 30-year fixed rate, so they get that fixed rate. And the loan amount is below the conforming loan amount for a single family home for their particular area. The key features: lower insurance cost than the standard conventional loans. Also, they can cancel that premium mortgage insurance when they reach that 20% equity in the home. And they may offer reduced interest rates and flexible income or debt guidelines. The lender may offer that with that loan type. Estimated monthly payment, assuming it's a home ready or home possible loan. The home price set at $473,684 with a down payment of 5%, which equates to $23,684. The loan amount set at $450,000 with an interest rate, which of course this would depend on whatever that was for this example, 6.75%. And the loan term here is 30-year fixed. Of course, actual rates may vary based on the market rates and the lender, but based on this example, in the next slide, we'll be able to estimate what that monthly payment will be with the conforming fixed rate conventional loan. And we have an estimated payment of $3,563 to $3,713. Based on what we see here, the principal and interest, $2,918. Private mortgage insurance, oh, I think I said premium before. Private mortgage insurance, $150 to $300. Again, whatever that is, this is just for this example, so that's going to be whatever the loan requires. Property taxes, $395. Homeowners insurance, again, that's going to fluctuate based on what their information is specific to their information, but here it's $100. So again, the total estimated payment, $3,563 through $3,713. What additional questions do you have regarding conventional loans? I hope this presentation has been helpful. For additional questions, information, or to apply, please visit www.accessiblelending.com or www.lendingforinvestors.com.